Hello, I'm really looking forward to today's webinar. The focus is going to be on how a reverse mortgage can better your retirement by utilizing home equity. This can be accomplished by creating additional cash flow or securing your future against possible life events, such as paying for in-home care, filling the income gap if a spouse passes away, or having a bucket of funds in a line of credit to better afford any unforeseen large expenses, such as maybe a roof, a newer automobile, or enjoying that trip of a lifetime. I ask you to hang in here with me for about 20 minutes, and you're going to learn a lot that you never knew before, I guarantee. And at the end, I'll give you some information on how you can get a hold of me and we can address your personal questions on your situation. The name of today's presentation is What You Don't Know About Reverse Mortgages and Retirement. My name is Pomeroy, and I'm with Reverse Mortgage Funding, otherwise known as RMF. And I've been a reverse mortgage advisor in the Portland, Vancouver area for the last 10 years. So today we're going to talk about the challenges. Some of those challenges is having enough money for retirement, depleting our retirement savings, possibly downsizing or right-sizing in the correct home, life events, those what-ifs that happen to all of us, or should I apply for Social Security and now, or should I delay and maximize a benefit that would last a lifetime? So what I ask you today is to look at home equity with new eyes, from a new perspective. The money for retirement used to come from Social Security, savings, and pensions. But for most of us, we no longer have pensions available to us. So what I'm asking you today is to look at equity in your home that may be another resource without having to sell your home, move, or pass away. Today's reverse mortgages are different than what you may have heard. So I heck 'em by any other name. We call reverse mortgages, but actually they're called a home equity conversion mortgage, or the acronym is HECM, and we refer to it as a HECM. HECMs are FHA insured, and they offer different protections, such as non-recourse protection. The funds are guaranteed as long as the borrower meets their obligations, and the line of credit actually has a growth feature. So there's big news for clients age 62 or older who own their home. Our low-cost HECM options eliminate nearly all closing costs and provides tax-free cash, and the costs are as low as $125. In this example, you can see the client is receiving payments of $1,849 per month for as long as that client lives in their home. So in 10 years, they've received $221,880. In 20 years, $443,760. Maybe you could use something like $443,000 in the next 20 years. All this for a $125 setup fee, which actually covers the independent counseling that's required by FHA and the annual fees that are included. So the same low-cost option can be used for the HECM line of credit. This slide depicts a home worth $625,000 and a 62-year-old homeowner. They're going to start out with a line of credit of $322,407. In 10 years, if they don't make any draws from that line of credit, it will automatically grow to $528,476, and in year 20, it would grow all the way to $866,254. No matter if the house was only worth $1, in 20 years, they could write themselves a check out for $866,254. Now, something that I think is really noteworthy, and you can see the box on the right that says noteworthy, is the line of credit is, if it's still in force, it's still in force when one of the borrowers predeceases the other. For example, let's say that the husband 10 years later passed away, and that line of credit has grown to $528,476. The remaining spouse can tap into that money, or she could convert it into a monthly payment for as long as she lives in that home to compensate for what she may have lost by her husband's passing, by losing a pension or a decrease in Social Security benefits. It's really a very low-cost assurance plan. So on an FHA-insured HECM program, there's some requirements. It must be the primary home and currently lived in as your primary residence. It's available for single-family properties, HUD-approved condominiums, or like a fourplex, 4-unit home. The money can be used to pay off a first mortgage or an existing home equity line of credit. The interesting thing about a HECM, it cannot be called or canceled as long as the terms of the loan are met. Client downsizing can use a HECM to finance part of their home purchase. There are options for taking your funds: lump sum, fixed monthly payments, a line of credit, or a combination of all the above. Now, the lump sum is usually a single withdrawal at closing, and this is usually to pay off an existing mortgage so that you can eliminate your mortgage payments and receive that for as long as you occupy the home. Fixed monthly payments are tenure, where you get a payment of a certain amount for as long as you occupy that home. A term is a fixed monthly payment for a specific term that the borrower determines. For example, on tenure, you might receive X number of dollars for as long as you live in your home, but perhaps you want more money than what the tenure would give you. Well, you can choose a higher amount, but it's going to run out at a specific time. And there's one other option that we want to cover, and again, that's the line of credit. The line of credit the borrower can access at any time. The unused balance has a growth feature, which means the borrower will have access to additional funds the longer they remain in their home. The unused portion grows over time. There's not another product like it in the universe. So here we're going to talk about cash flow reserve strategies. And you may not be familiar with this, but your financial advisor would be. And this is we start out with a 2-bucket strategy. So how this works is the investment portfolio bucket, the large bucket on the left, has the major portion of your investments. On the right, we have what we call the cash flow reserve account. And generally, that's 2 years of living expenses. The purpose of this is if the market is down, you don't want to continue drawing the same amount for your retirement if the market is going down. So you would stop or decrease taking the money out of the investment portfolio and start drawing from your cash flow reserve because you have enough money to last for 2 years. The unfortunate thing is that cash flow reserve account is probably earning very little, if anything. So we have another strategy, which is a standby reverse mortgage, and it's a 3-bucket strategy. So instead of having 2 years of monies in your cash flow bucket, we have only 6 months worth of living expenses. So again, on the left-hand side, you see the investment portfolio bucket. That's where the major part of your investments are. Those are the ones that are growing. That's where you're drawing your funds out to help with your retirement. Then you have your cash flow reserve account, but again, we've reduced that from 2 years to only 6 months. On the far right, we have the standby reverse mortgage HECM line of credit. Now again, that line of credit is growing, and it's there for a hedge of protection. But let's say the market goes down, and you live on your 6 months of cash flow reserve, and the market is still down. Well, then you can start drawing from your line of credit. to live on. Now, your investment portfolio will eventually recover and it'll increase, and then you can start taking your money back out of the investment portfolio, which was what it was meant for. And you've stopped taking the money out of the line of credit. So instead of the big advantage, instead of having 2 years of money sitting in some place that's hardly earning any interest or growing, you can put that money into your major investment portfolio and you're going to end up much better at the end of the day. So let's talk about the difference between a traditional home equity line of credit, known as a HELOC, that you would get with basically your bank or your credit union, and the difference between that and a HECM line of credit. A HELOC does not have that growth feature that we talked about. The HECM line of credit does. A HELOC can be canceled or it resets. For example, a line of credit is generally set up for 10 to 15 years. And at the end of that 10 or 15 years, they reset, which means the terms of the loan change. Instead of paying interest only on that, it turns into a set term and you're paying principal and interest. And this can cause quite a payment shock for a lot of people. The HECM line of credit does not have any kind of reset and it cannot be canceled or reduced. The HELOC requires monthly payments. The HECM line of credit, it's optional. If you want to make payments, fine. If you don't want to make payments, you don't have to. Some people will make payments and then during a period of time, maybe they're going on vacation, they decide not to make any payments. Or maybe the holidays are coming and they don't want to make payments. Or they may get to a point where they just simply don't want to make payments forever. And that's okay. Age restriction. Well, a HELOC has no age restrictions. You can do those at any time. But on a HECM line of credit, you must have equity in your home and be age 62 or more. The other option is the HECM for purchase, for right sizing. And this is a really interesting product and very few people really know about it, but it's been around since around 2010. This example, this chart shows you on the left-hand side at the top a purchase price of $325,000. The homeowner, if they're age 62, would have to bring in $167,809, and the balance would be financed with a HECM for purchase. And you wouldn't have any payments for as long as you live in your home. Let's talk through a HECM planning checklist. Borrowers have to be age 62 or older, and they should have at least 50% equity and generally have one or more of the following scenarios. They plan on living in their home for as long as they can. They need additional income, or they're at risk of depleting the funds in their retirement portfolio. They have mortgage payments and they would like to eliminate those so they have additional cash flow. Or they can benefit by deferring Social Security to get their maximum benefit. They could also be paying too much in taxes from their IRA distributions and use the funds that are tax-free from the HECM. And clients who are downsizing may use a HECM to purchase their next home. So now we're going to talk about some strategies using a HECM for your retirement. So this first strategy is a client who needs additional income. This is a 71-year-old Portland, Oregon couple with a $500,000 investment portfolio, but they're still working part-time. A possible solution is use a $100,000 HECM line of credit to provide extra source of funds as they need it. Plus, no funds are drawn, the unused line of credit grows. The remaining line of credit may be approximately $140,000 in 5 years if they don't take any draws, and nearly $200,000 in 10 years. And at that time, they could convert it into a monthly income or just use it when the need arises. The result is they eventually quit their part-time job and are retired. Now, our second example is a 64 and 70-year-old Oregon City couple. They have $2,000 monthly mortgage payment with about 9.5 years of payments remaining. The solution: use a HECM to refinance the $200,000 mortgage and eliminate a $2,000 principal and interest payment. The result is the client's retirement portfolio longevity is extended by 12 years. Our third example is having an emergency fund and a lot of flexibility. Now, case 3 is the clients with no long-term care insurance. 67-year-old Vancouver, Washington couple with a modest investment portfolio and receiving Social Security, but they don't have any long-term care insurance. The solution is put in place a $151,000 line of credit. Leave it and unused, and the line of credit grows to approximately $280,000 in 10 years and $520,000 in 20 years. The result: the client has a safety net that's accessible for in-home health care needs. Now, our fourth example is a client that wants to right size or downsize, and they also need some additional income. So this is a 67-year-old Wilsonville, Oregon couple. They're selling their home for $600,000, and they're going to purchase a $450,000 condominium. The clients have about $600,000 in their investment portfolio, and they need more guaranteed income. The solution: clients pay $209,000 in cash and use $241,000 from a HECM for purchase loan to finance their $450,000 purchase instead of paying all cash. Now, the clients have no mortgage payment with the HECM, and they use the extra $241,000 to generate $1,174 in guaranteed income with a single premium annuity. Maybe you're asking, what do I do now? Well, for a quote, all you need is to provide the date of birth of the youngest borrower. Give me an estimated value of your home, the total debt on the home, if any, the property address, and I can provide you with a personal quote. If you want to find out more, give me a call or email me. My number is 503-421-0798. And of course, my email is ppomeroy@reversefunding.com. Thank you for attending, and I appreciate your interest.